So the upload is being recorded.
Just recorded.
I'm recording that.
Yeah. Tell them they can send hate mail directly to Miguel.
They get to go home.
Yeah. All right, so this trial balance then is a listing of all the debits and credits. Where do you think we get the debit and credit balances from to put into the trial balance?
From the individual journal.
Yeah, from the individual accounts in the general ledger. All right, so for example, what is the balance of cash in our example?
20.
The balance of cash in our example.
Which one? The one I'm there?
Here,
13.
1,300, debit or credit?
Debit.
Debit. So on the debit side of the trial balance, you put 1,300. What is the balance of our revenue account in our example? Yeah, it was revenue somewhere. I don't know either. Did I rub it out? 40,000?
Yeah.
40,000.
Okay, they are down.
She can teach us.
They're recording. They are recording the class and they'll send it to you all.
Yeah, it's tomorrow.
So he said you can send hate mail straight to their office.
Absolutely, to Miguel and company.
So you all can send hate mail straight to Miguel. So, yeah, so you all feel like chickens.
Yeah, so tell those ladies they're doing the part 3, right?
So they can be spending time with you.
Oh my goodness, tell them the feeling is mutual.
They wake on the air already, Darren.
Yeah.
They wake on the air already. My God.
So I'll probably see them next week because we have session 3 coming up.
Okay.
All right. So on the debit side, our balance is 13. On the credit side is 40,000. All things being equal, is this trial balance in balance? Is it in balance? Are the debits equal to the credits? No. Usually if you have a trial balance where the debits are not equal to the credits, that means you did something wrong in the posting, or you did something wrong in the journal transaction when you record it. So if the trial balance doesn't balance, you need to go back to all of your transactions from the journal entry and see where the error occurred. If you don't see any errors in the journal, meaning the debits and credits, then you need to go to the ledger to see if you made any errors in what? Posting. Okay? Yeah, fine people money.
Right, that's just a joke that we said in the evening and somebody like show up.
No, I know, trust me. I remember that from I was a young teller at Citibank back in the day. Okay, 1,000,000 years ago. When you are out, dog eat your lunch. Everybody look at you suspiciously. Everybody's sucking their teeth. They want to go home. Did you make a legitimate mistake or did you teeth it? Fine it. Okay? So nothing has changed. So that's the purpose of your trial balance. All right? To test or to check the accuracy of your debits and credits in your general ledger. Okay? And every month, if a company is running things properly, or every quarter, they would run a trial balance to see whether or not what all those journal entries that they put in are correct. And all the postings are correct. Okay. Why is it not a good idea to wait until the end of the year to do that?
Because it's easy to do it, let's just say month to month or week to week.
Correct, even week to week.
Monitor it.
Correct. Yeah, if there's an error, you can correct. Absolutely. It's easier to find it weekly or monthly than at the end of the fiscal year, 12 months later. Sick, yeah. Dog eat your lunch. All right? And some organizations, depending on the size of the error, they just man, the hell with it. It's 3,000, we can't find it. That's it. But if it's 30,000, well, all hands on deck, depending on the size of the organization. If it's a Microsoft and it's 30,000, might say that's immaterial. Hey man, it's only 30,000, we know all day. It's costing us more than that to find it. Write it off, let's move on. All right, sorry?
He said, wow.
Yes, absolutely. So if it's a huge company, 30,000 might be considered a write-off. Let's not waste time. But if it's a middle-sized or average medium company, it's $30,000, hell no. Everybody doggone put on your pajamas, we're sleeping here. We need to find it by hook or by crook, or else. All right, did we talk about subsidiary ledgers?
Yeah.
Yes, we do. What's another name for subsidiary? Sub-accounts. That's where sub-accounts came from. Okay? So these are separate and extended accounts of what we call a control accounts. And generally we find them under receivables and payables, but certainly in the bank we can have other sub-accounts as well. Okay? In the normal business entity, sub-accounts tend to be restricted to receivables and payables. But perhaps in the banking system, they might have a whole gang of sub-accounts depending on what's going on. We all know what an invoice is. If you don't, say aye. But we should know. Why is an invoice so important?
Document.
It documents the history of the transaction, the details of the transaction. And in many ways, an invoice is an agreement, isn't it? Between the buyer and the seller, by all means. Now, this worksheet in accounting is simply, and you won't need to be too concerned about that unless you go on in accounting. But for general information, this worksheet is simply a summary sheet. By that I mean it actually looks like a worksheet like this. And it's an internal document that accountants use. Nobody really has to see it, nobody wants to see it, and accountants won't let you see it anyway. Okay? So what happens is a big old long sheet, whether manual or electronic. Okay? And then you have debits and credits here. And here we have what we call the trial balance. All right? And then we have debits and credits again. Then we have adjusting entries in order to correct the trial balance. And then we have adjusted trial balance. And then we go over to the income statement, balance sheet. All of these things are put onto one worksheet. And that's where the accountant does all of his or her dirty work to make sure that whatever errors are there can be corrected. And by the time we get to preparing the nice, wonderful financial statements, that the numbers hopefully would be what? Correct. Okay. Speaking about adjusting entries, anybody knows what an adjusting entry is?
Correction.
Yeah, it corrects a situation. Now, adjusting isn't always correction. Okay? Because you might find them being used interchangeably, but they're not necessarily the same. Okay? A correcting entry generally occurs when somebody makes an error. An adjusting entry generally occurs when we have, for example, an asset that is subject to depreciation. You follow? So the asset is costing $10,000 and the depreciation is $3,000. The adjusting entry would be what? $3,000. Because what will that adjusting entry do? Reduce the book value from 10,000 to 7,000. Absolutely. That's why insurance companies, they say, for example, as soon as you drive your car off the lot, they say it's depreciated by 20%. Now that must be criminal, because that is a lie. But that's what they do. And they're allowed to get away with it for some reason. The law allows them to get away with it. It's only the law because they're allowed to get away. Why are they allowed to get away? That's another story. My. Well, we don't know what goes on behind the scenes, do we? Okay, between politicians and business.
The world may never know.
And banks, no. Unless you're the fly on the wall, or you have inside information, or you're cute like LaToya, and so you're dating somebody who has inside information. He's talking, yeah, stuff like that. Oh, LaToya, you know we are a bunch of thieves. We all can. Then she said, "Oh, I see how the hell this go." Okay, unless you have like that kind of stuff, you'll never know. Like Darren said. All right. We have the sales invoice and the purchasing invoice. Basically, we all know what those documents are. Okay. The sales invoice is what? When you're selling something. The purchase invoice is given when you are, buying something. Receiving report is exactly what it says. Whatever you're receiving into the warehouse, you make sure that it's on the report. If it's not there, you make a note, tell the seller, send me my stuff. Or, I'm not sending that money for that item. As simple as that. Okay? Pretty straightforward. One of the things that sits in the definition of receiving report is not only the correct quantity, but also condition. Why is that important? Condition. If the goods are broken, they have to be returned. or replaced or not paid for. So when the receiving report is being done, it's not only enough for the persons to count the quantities to make sure they're correct, but also to check for the condition.
Yeah.
This job could be a boring job, but it is a very crucial job. And people who are doing this job have to be very meticulous and full of integrity. Because sometimes people manipulate the system for their own benefit. Okay? Or sometimes they don't really check. They say, yeah, everything came in, but they didn't really check. They just passed it into the warehouse and didn't count the quantities, nor did they check the condition. My. Okay. Purchase orders, we all know what that is. It is normally originated by the purchaser asking the buyer to ship goods and services. So once the buyer receives the purchase order, that's an instruction from the purchaser to the seller to send the goods and services. Okay. All right, we all know what the sales order is. This is originated by the seller. Okay. That he can proceed and go ahead and make things work as agreed. All right, the sales order have things like prices and delivery dates and another information like quantity and description, all that kind of stuff, so that buyer and seller are all on the same page. Okay? The checkbook needs no explanation, does it? Do people use checkbooks anymore? Yes, they do.
I do.
Yeah, you still use a checkbook? How often do you balance it?
Once per month.
Once per month.
I don't really use it like that. I use it to pay like my son's school fees.
Yeah, like specific.
Like post-dated check.
Correct.
Insurance.
Correct. But not necessarily for day-to-day business. Indeed. Any of you guys use a checkbook?
No.
What do you do instead?
Internet.
Internet banking.
Internet banking. That's sick. Do you use any internet banking?
I do.
Yeah. I keep internet banking to a what?
I really don't have to though, because I'm right there.
Exactly.
I don't do it.
Yeah. What is the great thing about internet banking?
You can use it
Quick and
anywhere.
easy and convenient.
What's
Take it
the
anywhere.
Anytime I want.
Yes.
Back in the morning.
what's the disadvantage of internet banking?
Impersonal.
Impersonal and?
Impersonal.
It's impersonal and? Or I'm the only one who sees it as a disadvantage? Maybe I am.
What's the other drawback, Mr. Wilson?
Everybody knows everything you do.
They go looking for it though.
I know.
Okay.
No, they don't have to go looking, it's right there. Because it has,
Corrupted, man.
no, when I say everybody, I don't mean the world.
Bank?
Yes, there might be some things you don't necessarily want your bank to know.
I feel like when you shop
But if you pay
online,
a
because
BEC,
if
for
you go.
example, sorry, go ahead.
Yeah, no, go on.
But if you pay a BEC bill through the teller,
Yeah?
and you pay a BEC through internet, what's the difference? Instead, you get to interact with somebody.
No difference?
No different.
Okay.
You have the same information lodged, your account
Okay.
number lodged,
We do the same
your
thing.
amount lodged.
Yeah, but if I go to BC and pay my bill in cash, then where is that? That is not there.
Well, BEC knows business.
No, that's okay, BC no. About my light bill, that's fine.
But you spend 2 hours on the line.
That's okay. Some things we'll die for privacy.
It's a passive
When you shop online, you give up a lot of privacy issues. I'm not saying it's not a good thing. It's okay. And maybe for some people these things are not privacy issues.
I see your point.
You see what I mean? For sure. So there's, depending on who it is, there's the pros and the cons. Yeah. I don't mind buying airline tickets online. That's yeah, preferably. But some other things, oh, Demond spend $30 for chicken again online. Yeah. Everybody in your grits checking stuff out. Let's check Demond this month. Yeah, exactly. That's what Latoya gets those doggone thing make her look so like doggone, what's the name? American Next Top thing. Then they get vexed with you. Exactly. All right. So we all know what the checkbook is. We know what the check is and how it works. We're all bankers. That needs no explanation. A bank reconciliation needs no explanation. The problem, what's the name of those wrong? The problem, a lot of companies though do not like to do bank recs. Bank recs are always in arrears or not being done at all. What's the benefit of a bank rec? What's the benefit of a bank rec? It checks the bank statement against your checkbook to make sure that everything is in order. If you don't do a bank rec, if the bank makes an error, how would you know? If you make an error, how would you know? Unless you do a bank reconciliation. And bankers are not perfect.
Or if somebody's using your check.
Of course. Yes. You have if you
Checkbook.
even when you check in your checkbook, where's check number 235? I didn't write that. Where's the canceled check? What is sick? You can't find it.
But someone have your code from online.
Of course.
Someone skip down.
Yes. But you won't know anything unless you do a
Reconciliation.
reconciliation. A lot of companies don't want to pay bookkeepers and accountants to do recs. Oh, I don't need to know because they don't want to pay. They think it's too much money. People charge them a lousy $300 to do the bank rec. Ah, that's too much. That time potentially you can lose what? Hundreds of thousands. Not to mention all the other problems and inconveniences. A lot of people have lost money they don't know have lost because they never did a bank rec. It just went into the wind. That is sick. All right. Bank statements, we know what that is. They go with bank rec and checks, but they're all related. It's a big family. Okay. Financial statements, we started to talk about those. These are the accounting reports that are prepared periodically. Periodically may be weekly, monthly, quarterly, biannually, and annually. Can it be longer than annually?
No.
It could be, but GAAP would not be happy. Auditors would not be happy. We tend to stop at 1 year because GAAP requires that anything going over 1 year begins to confuse the issue. Okay?
Preparing the financial statement will not be happy.
No, not at all. Okay? We have to have a cutoff period, and it's been deemed that up to 1 year is a reasonable time. Okay? Okay, then we have what are the main financial statements? There are 4 basic ones that we see. The balance sheet, we know what that is. What are the main components of the balance sheet as per the accounting equation? There are 3 of them. Assets, liabilities, capital. Those are the components of your balance sheet. What are the components of your income statement? Expenses and revenues. The difference equals what? Net profit or net loss. Okay. The capital statement, we know what that is. That's the owner's statement. Okay. And remember, the owner changes depending on what kind of company it is. We talked about 3 types of companies at the beginning. What were they again? Sole proprietorship, partnership, and corporations. Okay? For sole proprietorship, the capital is owned by how many people? 1. For partnership, it's owned by 2 or more. For corporations, it's owned by many. Absolutely. Okay? And the structure of the capital statement will change according to the type of entity and the size of the entity. Okay? We're keeping it simple, but as you go on to do more and more accounting, maybe one day you'll see more complex types of statements. All right, and then finally, the statement of changes in financial position. Now, this statement used to be called the cash flow statement. We still call it cash flow statement, but we have another nice name for it called the statement of changes in financial position. And we'll see later on that this account tells us where money came from and where money is going. The income statement doesn't tell us all of that. They tell us that we generate revenue, but not necessarily from where. Other than for expenses, we don't know what else money is used for in the income statement. You follow? So the cash flow statement or the statement of changes tells us exactly where the money came from and exactly how it was spent. And a lot of business people don't like that statement because it reveals things that they like to hide. Right? Yes. Okay. That's sick. All right, and then I put that in there just for your comfort. By the time you get here, all those things will become a bother. Don't worry, they'll all make sense. It's like swimming. I won't let you drown, though. We'll get, it's a little boring accounting job. So let's move on then. let's look at that equation that we talked about that is now being expanded. Did anybody look at this? Say hell no. That looks like crap. What's that? Is that a debit or credit?
Sorry?
No, whatever they were talking about, I was asking if it was a debit or credit.
It's a credit.
It's a credit? Asset or liability?
It's a liability.
Depending on the
Right now?
situation.
It's a
Right
asset.
now, it's an asset.
I don't want to expenses too high.
Later on,
It's a liability.
it's a liability.
My point exactly. I just want you to know that in case you think accounting is the most boring thing in the world, it's far from boring. It impacts every aspect of your lives, whether you are aware of it or not. Okay? Damon, you're married, right?
Yes, sir.
Is that an asset or liability?
Mostly an asset.
You mean you have a few liabilities occasionally?
Well, on, right?
No.
Liability.
Ah, Mother Saint. Are children assets or liabilities?
Assets.
They are?
Well, I have young children, so yeah, they're assets.
Well, maybe they'll become an asset later, for now it's all expenditure. When they grow up and do something for you, then maybe, or do something for country or both.
Small kids, small problems. Big kids,
Bigger problems. That means my married son now has become a bigger problem. Doggone it.
And when you catch the one end, that one gone.
I hope they don't go though. They just kind of appear to go.
No, I can't wait till the day it's
18? That's too young. Yeah, they'll be gone in your car.
Yeah, insurance.
And they don't want no rickety car either. If you don't have, you better insure it, because if you don't have insurance, they're going to sneak it out anyway. And if something happens, you have a bigger problem. All right.
Take off.
So, let's expand this doggone equation. On the left-hand side, we have assets again. Equals liabilities plus capital. Now, if you notice, under the capital, we have a lot of stuff going on. Capital begins with the owner's what? Equity. Then to that we can add at any time during the year
Investment.
additional money. Or the company might need additional money because all the money might be tied up where? In that same inventory account. And suddenly you don't have the BEC bill to pay. Light off. So the owner now has to go and find some money to put into the business. That's what this is. Whenever we generate revenue, revenue is added to what? The capital, and expenses are? Good night. And expenses are what? Subtracted from capital. So revenue increases capital, expenses decrease capital. What about drawings? What do you think drawings are? Yeah, withdrawals from the company. Usually drawings are money taken out of the business for the owner's personal use. Okay, they're not expenses. So the owner needs some money for something personal and they need to take it out of the company. We call it a drawing. So instead of increasing capital, a drawing does what? Decrease capital. So it's a reduction in capital. Does that make sense? And then the result is whatever the result is, ending owner's equity. So an owner can start off with whatever at the beginning, but revenues, expenses, and drawings will impact that original investment, and we have a new number showing up at the end of the month, quarter, or year. What's going on in this column here? Yeah, this is the revenue and expense column, okay, or what we call the profit and loss column, and we know this formula already because we've pretty much beaten that to death. Where do you think the profit or loss will be transferred to once we determine what it is? Back to the equity or capital account. Absolutely. Okay? Absolutely. All right. So, what does this table tell us? Well, we were just talking about it, but it says some more. We know that. We know the table tells us that assets equal liabilities plus equity. We know that the table tells us revenue minus expenses equals profit or loss. Do we know the third thing? Did we discuss that?
Yeah.
Yes, we did. Changes in owner's equity. Okay? Beginning equity plus contributions plus revenue minus expenses minus draws or drawing equals ending in equity. Not a problem. All right? Now, this little note at the bottom, is that true or false now? The last note at the bottom, is that true or false? Let's say that's a test question. True or false? True. Okay? Asset accounts always have normal balances that are debits. Now remember, last week we stopped at debits and credits and how it impacts these various accounts in the equation or the ledger. Those debits and credits that increase and decrease those accounts, if that process doesn't come naturally to you, that's okay. Some of it you'll know from work, some of it you'll know already from somewhere, and some of it you're like, damn, what is that? What is a normal balance? That's okay. What you have to do is just keep practicing. Eventually, it comes. Okay? I tell students, even if you need to sing it over and over for a while, you know, debits increase, assets, expenses, and drawings. Whatever you need, credits increase, until you get it. Whatever the hell works. Okay? But it certainly doesn't always come automatically, and that's okay. What else does the table tell us? Anybody? True or false?
True.
Okay. You're going to learn a lot about how debits and credits affect these accounts just by going through this process. Next line. Equity, normally has a? Okay, next line. True or false? True. Next line, true or false? Okay. Revenues, next line, true or false?
True.
This thing about added to the owner's equity, what does that mean?
Capitalized income.
Yeah. It's capitalized income, meaning any revenue that you generate will increase equity. Any expenses that you generate will decrease equity or capital. Any drawings that you take out of the business will do what? Increase or decrease capital? Decrease capital, yes indeed. All right. So all of a sudden now, some things make a little more sense than before, especially when you get to understanding the impact of these transactions on the capital account. Once you get that down pat, you're like rolling. Because the other stuff is not simple, but it's not difficult either. Usually understanding the changes in the capital account is what ties up a lot of students initially. All right. More notes. Now, besides the owner's original investment, the owner may have to contribute. True or false? Yeah, we know that already. Not a big deal. Next note. Investments are normally added. True? Draws are normally subtracted. We know that now. We are experts on that crap now. What about the next note? Are we experts on that? Is that a true statement, that first sentence?
Yeah.
The drawing could be equal, less than, or more than profit.
Yes.
Of course. You could be making a loss and still withdraw. Why? Because the withdrawal will what? Increase the loss by reducing the capital and also decrease your what? Cash. The point is, as long as you have money to withdraw, you can withdraw, even if you're not profitable. Is that a good idea though? No. Never is a good idea. Unless you have a major emergency like medical. Your child is sick. And doctor's hospital tell you they're not touching no children until you come up with $500. So then you don't have $500 in your personal account, so you have to go where? To the business account and withdraw it. That might be a reason to do it. Okay? All right. Now we're going to look at a couple of transactions, very simple ones, but it's just designed like exercising. We call it an accounting exercise, so you can get into the kind of day-to-day, just for the purposes of knowing a little bit about the mechanics. All right? Not necessarily that it'll turn you into an accountant overnight, or some great big time bookkeeper overnight, but it will introduce you to the mechanics, and that's really the idea. Okay? So that when you move on one day, or you have your own little thing going on, or you're looking at a client's situation, you can say, hey, I know something about what the heck I'm looking at. All right? Did anybody look at those transactions?
Yeah.
Yes, indeed. Now, the reason why I'm not going to go over these transactions is because I'm going to move now to where we analyze them so we don't, what? Do it twice. Okay? So let's move on down to the analysis because we will basically have the transactions there. Later on, we restate them, so we just do it once. Okay? So we go down. Are we at the analysis yet, or are we still in transactions? Still in transactions. Now we'll discuss the transactions, post and blah, 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 and chit-chat about what really happened. Okay? Notice for each transaction for the company, we will identify the what?
So,
What is the source document? Yeah, proof of the transaction. Don't let anybody ask you to journalize or post anything without a document. Say, man, do it because I tell you to do it.
that's right.
Is that enough?
Yeah.
Hell no. We tell I'll be happy to do it, sir, if you give me the source document. But I don't have it. You don't. I'm the boss. Take my word. Debit this and credit that. I'll bring the paper later. What did you get? Yeah. So you write up the transaction, let them sign it. If you have to go that far. But really, you shouldn't have to go through all that. Wherever there's a transaction, there should be a what? Source document as proof of the transaction. Whether it's a mortgage document, invoice, receipt book, whatever the case might be, it must be there. Okay? Then we're going to look at what type of the transaction it is, what accounts are affected, and explain debits and credits as we go so you can see how the T accounts are impacted, how the ledger is impacted, and so on. Okay? So let's see. Entry number 1. We already read through the transaction. That's the assumption I'm making. It's hell of an assumption, but I'm making it. Okay? What is the source document? The check in this case. Stop me anytime. What do we debit and what do we credit? Debit cash and? For how much? $50. Is the accounting equation, the double entry procedure in place here? Okay? We have to do that every single time. Why do we debit cash?
Because cash increased.
Because cash increased. You received cash, didn't you? See? Receive a check. Now, some people have argued initially like, we receive no check, cash, we receive a check. Because a lot of people still don't know that a check is equivalent to? Believe it or not. It could bounce, yes. But remember, on accrual accounting, we don't assume it's going to bounce. Accrual accounting assumes what? The best will happen. That your check is good. That when you sell on credit, people will pay. That's what accrual accounting is all about. Cash accounting is doubting Thomas. Cash accounting says, I'm not recording anything until I get my money. But GAAP doesn't require, GAAP frowns on cash accounting because it's too restrictive. Accrual accounting is accepted by GAAP because accrual accounting allows you and forces you to create the entire picture and leave an audit trail. That's what auditors are about, leaving a trail. Okay? Pay everything online, leave a trail. How could you say your light bill is $300 and I check online, it's $550? You lie, how you know that? It's right there. But if I pay mine in cash and I tell you it's $3. Okay. Just a little argument for cash still. But we're running out of the cash situation. Some people will no longer take your cash. Is that a good thing or bad? Bad. Okay? Some places in the US now, in Europe for example, you show up with cash, they will not transact any business with you. Yeah. Sir, your card please. I don't have a card, I have cash. Oh, I'm sorry. You're not taking my money? No, sorry. You don't want my business? Yes, but we don't want your cash.
Why is that? Liquidity problem?
No, because the world system is getting more to a cashless society and they're forcing you to use a card.
But wouldn't you have to comply with central bank's limits and stuff like that in terms of the holding shipping?
Not necessarily, not for a basic transaction like having a credit card or using cash. There's not a problem there. It's just that, for example, if you go to rent a car and you try to pay in cash, you may not be able to get the car.
Yeah.
No, you can't.
No. Why not? You should be. They should have a facility to receive your cash. Give you a what? Receipt. But a lot of systems are now forcing you to have a card. And eventually more and more places will be like that. And soon, when you show up with money in your pocket, they won't do business with you.
Track credit.
Wow. That's crazy. But that's what it's coming to, a cashless environment. And the problem with the cashless environment is, if the machine doesn't work, you're stuck. If you don't have good credit and can't get a card, you're stuck. And all kinds of other things, you're stuck. And your money will not help you. Your cash, I mean, in many environments. That's spooky. Sounds like the Antichrist is there for those of us who want to extend our minds. But remember, the goal of the Antichrist is to know where everybody is, so that you can get your
Wow.
yes. If you're still paying cash, they may not be able to find you so easily. But if you have a card, dog eat your,
You know.
they can find everybody with a card. And that's the idea. My. So that's entry number one. Any question on that? It's a sale for cash. That's all it is. Debit cash, credit revenue. Pretty straightforward. And all that crap is for those of you, when you go to sleep tonight and you don't remember, just read that. It's the same thing. Okay? This is a detailed explanation of the fact that we made a cash sale by debiting cash and crediting revenue. Okay? This is in layman's terms so that you can actually go back and re-understand it if you didn't get it the first time. Okay? All right, entry number 2, source document. Supplier's invoice. Did the supplier give you any time to pay this thing? 15 days. That means it's a cash or credit transaction? Credit, of course. And in accounting, when you have a credit transaction, what's the double entry? Debit? Not accounts payable, because accounts payable is a liability. And the normal balance for liability is? Yeah, debit inventory. Well, we don't call it inventory. We call it, well, okay, we'll go with that. We normally call it purchases. But we debit purchases or inventory of office supplies, because that becomes a what? If we debit it, it's a what? An asset, because we own it. Okay? Since we're paying later, we don't pay in cash, so we credit accounts payable and liability account. When do we have to pay it? In 15 days. If we don't pay it in 15 days, what you think might happen? Or charge you a late fee. And banks know everything about late fees. They're the masters of late fees. Okay? What's the fee now for paying credit card payment late? Mother's sick. $32 for late fee. Mother's sick. Plus VAT. Is that fair? Who cares? If you don't like it, pay on time. That's what you get for having a card. But you have to keep the card, because a lot of places are not taking your. My. Any question on entry 2? Pretty straightforward. It's the first one was a cash transaction. This one is a credit transaction. Okay. Number 3. Source document for number 3. Source document. Supplier's invoice and company check. All right. What is happening in this transaction? What kind of bill? An advertising bill. Tribune, Guardian, or any other bill. Okay. Cable Bahamas. Advertising bill. Are we paying for paying in cash or credit? Cash. So what's the entry? The advertising bill is an expense, isn't it? That's an expense of doing business. Advertising for some companies is a major expense. Okay? So they're tracking that carefully. So what is the normal balance for an expense? Debit. So we debit advertising expense here. And what do we credit? cash because money is coming out of the cash account on the credit side. Now, in this example, we have the indentations in the wrong place. And when I say wrong, I don't mean it's wrong, it's just wrong. Wrong in the sense that GAAP normally encourages you to indent the other way. So if you have, this is your debit, this is your line, it's your margin here, the debits would normally go to the left and the credits to the right. Okay? So that anytime you look at a transaction, even if you don't see the words, whatever's to the left, that's a debit, whatever's to the right is a credit. This is the reverse, doesn't mean it's wrong, because the transaction is still correct, debits and credits. It's just that it's not sitting in the gap position, that's all. Okay? So in practice, you normally would not see it looking like that. You would normally see the debit to the left and the credit to the right. All right, again, a detailed information, how fun if you sleep and forget. I guarantee you this will walk you through it again so that you can be refreshed. Entry number 4, source document. Banknote, which means the company did what? Borrowed money. How much did the company borrow? To do what? Purchase an asset called equipment. The mowers. All right? So if you purchase equipment, do you own it or not? Yes, you do. Yeah, but remember now, under the accrual method, we say you own it. But we know that there's an offsetting, and we know what that means. Okay? So we debit what? The equipment for how much? 10,000, and we credit notes payable to bank, you people, for $10,000. Okay? Pretty straightforward. What about transaction number 5? Source document? Sales invoice. What is this transaction? Can anybody analyze that? What happened there? Yeah, you're invoicing somebody for a service you did. Invoicing means that you are not going to be paid in cash. Yeah, so you're offering credit to your client, which means that they owe you money now. And if they owe you money, you must, in your books, you must debit. They owe you money. Of course. In your books, meaning the company's books, you must debit accounts receivable because people owe you money. That's why we call it a receivable, because we expect them to pay us so that we can receive it. On the other side, if you owe the bank, the one we saw before, we have a note payable because you have to pay to the bank. See how that works? So on this side, we have sold on credit, so we debit accounts receivable, and what do we credit? Sales or revenue. Remember, under the accrual method, we don't care whether the money is paid at the time of sale. We still record it as a revenue or sale. Okay? If it's cash we receive, we debit cash. If we sell on credit, we debit accounts receivable. Okay? How do you get really good at this stuff? Time and practice, like everything else in life. Okay? When you go on the system to be a teller for the first time, you don't know a bloody thing about how tellering works. 3 months later, though, you're stamping the crap out of checks, aren't you? Because you've been practicing, and it's the same principle. Okay? Don't worry if it doesn't kick in right away, all of them, but eventually they will as you deal with it more and more. That's how it is. Okay? All right. Entry number 6, source document. Check. What happened in this transaction? Withdrawal. Now, when we withdraw, which account is decreased? Cash by which entry? Debit or credit? Credit. And what entry is debited? Sorry, which account is debited? The equity, but we don't call it equity. What do we call it? We don't call it capital, but what do we call it in the journal entry?
The owner's draw?
Yeah, the owner's draw. Because we know the draw will do what to equity? Reduce it at the end of the day. But for accounting purposes, the actual account is called this, see? Yeah, because that's a separate account, which will eventually, at the end of the period, reduce capital. Absolutely. But for transaction purposes, we have to set up a separate account in the ledger called owner's draw, or better known as drawings. Okay? All right. Transaction number 7, what's the source document?
Check.
Check. What happened?
Check.
Yeah, the supplier.
We pay.
The supplier pays?
We pay.
Well, you pay,
She said we pay. Is she correct?
Yeah.
Yes.
He pays off.
Did we pay in cash?
Yeah.
Yeah. So our cash goes down by credit of how much?
$100.
What is debited?
Accounts payable.
Why?
Because-
Reducing our payable.
Yeah, that's
Because
it.
remember, yeah, the actual account is payable looks like this. Another, just like any other account, accounts payable, the original amount was,
100.
let's say $100. We pay it off, so we debit it. Balance, 0. Why is it important to be so meticulous? Because if you don't do it right, then the balance will money will come in, but the balance wouldn't be reduced. Then somebody said, John, you still owe me money. He said, no, I paid them. I don't scala. I have to cancel check. Then you have to go back to your environment now and see what your accountant and bookkeeper did. Okay? That's how it works. All right, entry number 8, source document.
To the invoice.
Customer check. What does that mean?
You gotta pay it.
The customer paid you on your receivable account. So you received money, what do you debit?
Cash.
Cash, and your account is now paid up,
So they paid out.
maybe paid out, but certainly paid up to some amount.
Yeah.
All right, so you credit your,
Receivable.
yeah, because remember, the original balance of the receivable was a what? A debit, an asset account. All right, and for how much?
75.
$75. Okay? So you see, once you get into a role, it starts to become almost second nature. Once you start understanding the fundamentals. All right, entry number 9, source document.
Invoice.
Supplier's invoice. Okay? Is this a transaction on credit or cash?
Credit.
Credit. So therefore, what do we debit?
Some expense account.
Mulch. Remember, this is a mowing company. That's that thing that you put around the plants for it to grow. Blah, blah, blah. So we debit mulch expense because you have to buy big bags of that. The Hilton buys a lot of that crap to keep its garden what?
Pretty.
Absolutely. And if you've been there lately, it is beautiful. Okay? It's nice to just walk around and say, oh. And since I work in the Hilton building, like every time I go outside, you start feeling lazy. You just want to hang in the green, pick a rose. Yeah, it's beautiful. Okay? That's what the mulch is for. So we debit mulch expense for how much?
$60.
$60, and you have how many days to pay? 15. Therefore, we credit accounts payable for the same amount. Okay? Great stuff once you're on a roll. Entry number 10, source document. 2 of them apparently. Sales invoice and
Check.
customer check. That's interesting. Type of transaction is a cash sale. Is that true?
No.
She said, I don't think so. But
Well,
this-
hold on. Yeah.
What? So yes, no, yes, no. And let me say, hold on.
You
And that's okay. That's what people do in practice as well. Hold on. Let's see what the hell it is.
Cash?
Is it a cash sale?
Yes.
Why do you say that?
Because they receive a check.
Because who received the check?
The company.
That's us.
Yeah.
We received the check, yes. Of how much?
80.
$80, so we debit cash. And what do we receive the cash for?
Mowing the yard.
Yeah, we generated revenue by mowing the yard. So we call it mowing revenue. Or sales. Same thing. Any questions so far? And that's what you do all day in the accounts department. Debit and credit the hell out of everything. And when you start getting bored with it, you stretch and go back because you can't afford to make any Errors, yes. Because at the end of the day, those errors impact a whole lot of things down the line, a whole lot of decisions that are made by management. And if you piss somebody off with too many errors, our head will, somebody's head will roll. Let me put it that way. All right. So those are our 10 transactions, very typical ones, very day-to-day ones. They were selected for a particular reason. Now that we have done those entries, we've analyzed the transaction, we prepared the journal entries, we have the right debits and credits, we think. Now we can look at our assets and liabilities and equity and see where we are. Now, according to this, our cash balance is what? 5,080. Receivable? 1,600. Equipment and inventory? 100. Those numbers look familiar? Yes, they do. They're all in the asset side of the report, which means that their normal balances are debits. Make sense? Then right under that we have the liabilities for this company, which are the accounts payable and the amount owing to the bank. According to this so far, have we made any payments to the bank? Hell no. Because our original transaction was 10 and still 10. So we haven't made any payments yet. Okay. What is missing from this chart so far? Equity. Because if we add all of these up and all of these, this will not balance so far. So there's a third part to this report. It's called the equity. Now notice the analysis in equity. Notice the wording on the right, the debits and credits. We have the whole analysis for equity again so that you can see which transactions impact equity. Just as a reminder. Okay? So our original opening balance in capital was how much? Debit or credit?
Credit.
Is that a normal balance?
Yeah.
Yes. Increased by? Mowing revenue. Decreased by? And all of which are debits. You see the trend? Even if you don't get it, but you didn't get it last week by seeing all those debits and credits up and down, just by going through the process now, things start to stick. And soon it'll become permanent in some cases and you can't shake it off. Right, okay, I'm finished with that class now and shake it off. Doesn't go anywhere. Alright. Now, I don't know if anybody looked at all that, but the problem with looking at stuff rather than checking it out, if you just look at stuff, sometimes you'll say what? Piss on it. Record that. Okay. You say the devil with it because it looks like gobbledygook. But really, it's very simple. All this is saying is, we're adding what? All the assets. Do you see that? We're adding all the liabilities. We're adding all the equities. That's all that's saying. Does everybody see that? And where did we get this information from? Here and here. The point is, if you just look at it like, oh my God, it's 12:15, that looks like crap. Let me move on. And so once you add up all these categories, then we come up with this simple equation again. Do you follow? Where assets equals liabilities plus. You add these two together, they'll always equal that. This will always equal these two together. If they don't, you did something wrong. That means you have to go back to that, and that, and that, and see what I mean? Until you find the problem. That's how it works. Okay? Alright. So now, that was the first check. Second check. The second check looks like a what? Trial balance. Remember the definition of the trial balance? All of the debits are on the left, and all of the credits are on the right. That's all a trial balance is. Just as simple as that. One of the easiest things in accounting, the trial balance, but a very important thing. Is the trial balance in balance?
Yeah.
Yes.
Somebody said no. Are all the debits equal to all the credits?
Yeah.
Yes.
That means the trial balance is in balance. That means theoretically you've done everything correct in your journal entries and your general ledger, your postings. Okay? If something was out of balance and they didn't balance, sorry, you have to go back and try and find out what happened. Sometimes that could be a very tedious job. Okay? Trust me on that one. So much so that sometimes people never find the error, or at some point so many man hours are being spent, you say what? To hell with the error. We're losing more money trying to find it than the amount itself. Write it off, put it into, short and over, under and under, black and white, put it somewhere. Suspense, it can hide, Kingham account, miscellaneous. Just get rid of it. And then we get rid of it. All right, so that's your trial balance. Now the accounting cycle, I don't need to say anything about that. If you guys don't know what the accounting cycle is yet, after that paper, then somebody else did the paper for you. Okay? But basically the accounting cycle is just 1, 2, 3, 4, 5 basic steps. Okay? Which question was that in your paper? The first one. Okay? And the cycle begins with what? The transaction. What happened? See? Cycle. What's the next step after the transaction? You must journalize every single transaction. And the journal will be consisting of what? A debit and a credit. What's the next step in the cycle? Yeah. What do we do in the general ledger? Yes, and when one word, what do we call that? Posting or summarizing. But posting is the most common word. Okay? So we post from the general journal or the journals to the ledger. Any other steps? After the GL, posting, what do we do? Prepare a trial balance so to see if our balances in the GL are what? Correct. And then finally, financial statements. And then after that, you do it all over again. And again, and again, and forever and ever, as long as the entity is solvent. Okay? All right. So there you go. So we know what they are now. Those 4 statements, we know them. Doggone it. They bore us now. We can move on to something interesting. Do we know this? Yes, we do. We know that equation. We don't want to see that anymore. Because that's only going to make us upset. We know what the accounting equation is now. We know what assets are. And we know what the normal balances for assets are, which are debits. That's it. Okay. Balance sheet items are all owned by the company. Liabilities represents what is? And capital represents the owner's investment. Doesn't hurt to say it one more time. All right? Now, if you are itching to see what a balance sheet looks like, there you go. Scratch, there it is. How's that? Now you can see all the types of accounts that sit into the asset side, all the types of accounts that sit in the liability side, and all the types of accounts that sit in the equity side. Now, what is a little different from about this balance sheet than the ones you may have seen earlier? Yeah, we didn't have a depreciation before account. So here, we're showing equipment as 80,000. Depreciation is how much? 1,100. So that means the net book value would be what you think? The difference between the two. Yeah. Okay? So the book value would be the difference between 80,000 and 1,100 in the first year. And we do 1,100 the next year and the next year, and we keep doing that. That's how depreciation works. Okay? Equipment and any assets that have a life longer than 1 year would show up as current or non-current. Non-current. So all the non-current assets are here. Like equipment, in this case, only one non-current. But we could have land, buildings, and all kind of crap in there. They would all be non-current. All of the current assets are shown at the top. And we can see what they are. We know about that Canada. Prepaid rent. Anybody knows what a prepayment is?
No. Yeah.
Yeah, when you pay up front. Yeah, when you pay up front.
You pay as that.
Yeah. When you go to J.S. Johnson to pay your car premium at the beginning of the year, is that a prepayment?
Yeah.
Yes, it is. Because you're paying insurance for what? The year to come. So they have your money for the whole year. But what they do is, every month, they depreciate for a month. You follow? Or amortize the amount that you pay. So, if you pay premium of $4,000, God forbid, okay, they divide it by 12, and each month, how much is that? 4,000 divided by 12 is whatever it is, okay? And each month, that amount is the expense, okay? So, let's just make it easier to 4,800 divided by 12 equals what? 400 per month? So it becomes what? Insurance expense for the month of January, okay? And then the prepaid insurance account is reduced. But that's some stuff that you'll see in another accounting, more advanced accounting class. For now, prepayment is an asset because you paid where? In advance. And because you paid in advance, you own it. But as the months roll on, you own less and less of it, you follow? Because some of it will be used up each month, just as it is with depreciation. Okay. So 6 months into your car insurance, how much insurance do you own?
6 months.
Only 6 months, because you already used up the previous 6 months. Yeah, that's kind of how it works. Okay. The payable accounts, we know, this means we owe suppliers, we owe BEC and water and sewage. Unearned revenue means what you think?
Credit, what people owe you?
Unearned revenue. Why is that a liability?
Would that be,
Unearned revenue is money you collect, but you haven't performed yet. And people in the Bahamas like to do that. I need a down payment, then they don't come back. Is that true? Have you ever given money for somebody to do work and they don't come back? That means on their books that is unearned. They owe that money in work. Does that make sense? Unearned. So you get money in advance of performing the service. So because you get the money in advance, you owe the service for that dollar value. And so in accounting, we put that into unearned revenue. When do you earn it? Of course.
Well, you will never perform the way.
Then what?
Will that go to the other side?
If you never perform the work, what happens? You have to write it, yeah. Okay, absolutely. Because see, what happens is, somebody gives you $1,000 down, what will you do? You debit what? Cash. They gave you the money up front. So you debit cash for how much? And credit? Unearned revenue. Because you have not done the work yet. When you do the work, then what do? Debit unearned revenue. Because you no longer have a liability. So you debit unearned revenue for $1,000. What do you credit?
Yeah.
Not cash, because you already got cash in the beginning. Sorry? Revenue. Because you now earned it. Okay? Don't worry if that doesn't kick in right away. That's just a little introduction to other blah, blah, blah in accounting. Okay. All right? And then, of course, these other payables, you know. Interest payable means you owe interest. Notes payable means you owe the bank. Correct?
Yeah.
Now, this is not a sole proprietorship, is it? This balance sheet.
No,
How do you know?
common stock.
Common stock. If this was a sole proprietorship, this would have been equity or capital. If this was a partnership, it would have been equity or capital. Because it's common stock and retained earnings, then we know it's a corporation or company. Okay? So that's just a little introduction. Don't stress if all that stuff doesn't kick in right away. You won't be asked to do more than is available to you. Okay? Is this balance sheet in balance?
Yeah.
Yes, it is. Total assets equal? How much?
133,530.
And total liabilities
133,530.
plus equity together
Oh, sorry.
equals yes. Okay. Yeah, don't let me get a little trick question like total assets equal what are total liabilities. So used to balancing out, so you said the wrong thing. Sometimes we do that. All right. Well, we don't need to talk about that. We know. This baby is just an expanded income statement. Okay. For example, if you have a look, we have sales less cost of sales. Now, anybody knows what cost of sales are?
Cost of part purchasing.
Yeah, the cost of the inventory that you purchase. All right, that's all that is. When you take out the cost of sales from the sales, we end up with what? Gross income. From that, we subtract
Expenses.
operating expenses. After we subtract operating expenses, we end up with what? Operating income. Then if you have any other income like interest, any other expenses or income, we put that in this line. If it's an expense, this will have a what?
Bracket.
Bracket. Because it has no bracket, it means it's what? Income, absolutely. And if something burned down like in the plant, we have an extraordinary gain or loss. In this case, we have an interest expense that is extraordinary of $50,000. So something happened that cost the company $50,000, absolutely an extraordinary loss. Why do we call it extraordinary? Because it doesn't happen every year. It's a once in a lifetime situation. What are the details? We don't know. How do you know? When you do more crap later. For now, that's all you need to know. Okay? So net profits before taxes equals 905. How much are the taxes? 300,000. Net income 605. So you can see the balance sheet and income statement for a company is inherently a little more complex than what? A sole proprietorship. Okay? By all means. All right. Now, don't lose sleep trying to figure out, well, what is an extraordinary gain or loss and all that stuff. Just know that if it's a gain, you add it. If it's a loss, you subtract it. That's all you need to know for now. Okay? That kind of stuff. Profit before taxes, all this stuff will be given. Because at this stage of the game, it's only to introduce you. Okay? Give you a snapshot of a very simple company statement as opposed to what we saw earlier on the sole proprietorship. That's it. Alright, the statement of owner's equity. Very simple statement. We start off with capital at the beginning of how much? 10,000. How much was invested during the month? 1,000. How much net income was earned? 3,000. Notice these three categories are all additions, correct? Adds up to 14,000. Any withdrawals? $2,000. So capital at the end of the month, 12,000. Very simple. Okay? It's not design. It's never more complex than that at this stage of the game. Never. All right. Now this cash flow statement. Remember, I told you this is the document that tells anybody who's looking at it where the money came from in detail and how it was spent. Okay. It's a very important statement, and a lot of times owners don't like it to be known because you can figure out what they're doing with the money, and sometimes they're doing what? Stuff with the money that they should not be. Especially when they go to their bankers. Because the banker wants to know, like, what are you doing with the money? Don't put our loan payment in jeopardy. If you keep wasting the money and taking it out of the company, soon you won't have any money to pay us. And we are not happy about that. Okay? So the cash flow statement for your purposes means that you only need to know that there are three categories. The operating side, the investing side, and the finance side. Okay? For now, that's the most important thing. What is the operating? Yeah, the day-to-day activity. In this case, converting what? Items reported in the income statement from the accrual to cash. Now, all you need to know at this stage is the definition. Don't worry about how do we do that. Hell no. You will not be responsible for that at this stage. All you need to know is the three categories and the three definitions. So the operating activities from accrual to cash, investing activities reports the what? Purchase and sale of long-term property, plant, and equipment, and financing activity has to do with what? The issuance of stocks, debts, and other securities. That's all you need to know for the cash flow statement. Between the three of these, it'll tell the reader where all the money came from and where all the money went. It's a fabulous statement. Okay? And if you ever go on to do more accounting, you'll see why. Okay? All right. And then finally, we have the analysis that is sometimes done by banks and other users of financial statements. I don't really want you to lose a whole lot of sleep on the analysis side of things. I just want you to be able to understand the definition of each analysis and a simple calculation. Okay? That doesn't mean you shouldn't read it. I'm just saying, like, don't get all tied up with it. Okay? For example, all I need you to know is, what is the definition of horizontal analysis? You follow? And here's what it looks like. Is this horizontal or vertical?
Horizontal.
Yes.
Because you're looking at year.
Well, we're comparing which years?
2008.
2007, 2008. What do you think a horizontal analysis looks like? Which direction should we be going? Across or down?
That's the right.
Across. Correct? So we start with current assets. In 2008, current assets were what?
650.
What number is that? 550? And 2007 it was what?
633.
The difference? 17,000. And if we divide 17,000 by the base year, which is always the year before, it will give us what? 3.2%. And you do that for what? Every line. And if you do that, and it's the same mathematical function for every line. This, straight down. And by doing that, you can then go over here and say, hey, current assets increased or decreased? Increased by how much? Okay, long-term assets increase or decrease? The brackets mean decrease by how much? 46%, of course. It went from 177 to 95. And you can see right away, when you see these numbers, especially the decrease side, you want to ask questions like, why? All right? But you'll get into all the whys later. All I want you to know is how to do the basic calculation and what it means. Okay? And all for your purposes, you're just taking the current year minus the previous year, dividing by the base. That's it. To come up with these percentages. That's all I want you to know. And to be able to say, without brackets, an increase occurred. With brackets, a decrease occurred. Okay? That's all you'll be responsible for test purposes. Nothing else. So I want you to get tired of all that madness at this stage. If you're bold enough to go on. All right, same thing with the horizontal analysis of the income statement. Is it the same? That from that equals that divided by the base equals that. Does that give you the same calculation? Adding? No, we take 2007 from 2008, which is 298 difference, divided by the base year.
That's million, sorry.
Oh, yeah. Does it give us the 24.8?
Yes.
The morning is still calculating. Anybody else got 24.8? No answer. Did you? Who got 24.8? Take 2007 from 2008, which is 298 divided by the base year, should give you 24.8. Similarly, if you take 197.4 from 104, gives us this divided by the base year, should give you that. It should all work out, and that's all you're gonna be responsible for the income statement or the balance sheet, and be able to say, okay, doggone it, and cost of goods sold. Increase or decrease? Increase. Sales, increase or decrease? Any decreases in this income statement at all? Where? Yeah, those are the kinds of questions. That's all I want you to be able to do. Calculate the percentages and just say where the increase and decrease occurred. Okay? And if you can do that, that is a big step, by the way. All right? Even though it's a doable one. Okay, that's all I want you to know about horizontal analysis. All right? You can read that other stuff, that's just for edification. And it all talks about the calculations, what we just discussed. So it's no new information. Vertical analysis is the opposite side of horizontal. Which direction do you think you'll be going? Across or down? Down. See? Down means what? Taking the current assets of what? 550 and dividing it by the total. If you do that, do you get this number? This percentage? If you take current assets and divide it by total assets, do you get this percentage? Believe it or not, it's the same arithmetic you did in high school. It just looks big, like a big deal up there.
Yeah, it is.
You said current assets.
Yeah, divided by total assets.
Yeah, it is.
If you take intangible of this amount divided by total, do you get 4.4? Yeah, it's the same arithmetic you did in high school. Believe it or not, it stinks. But that's all it is. And that's all you'll be responsible for. And again, all I want you to do is say where the increase and decreases occurred. For example, in 2007, did the percentage in current assets go up or down?
In 2007?
Yeah.
If what?
The percentage in current assets, did it go up or down?
Down.
Well, it went up from 2007.
To 2008.
Yeah.
It went up.
Yeah.
Okay. Does everybody see that? It went from what?
43.3 to 48.
Absolutely. Is that significant?
Yeah.
Why? Why do you think that's significant?
I think that's significant. 'Cause,
Well, anything up is always good on the asset side.
Yeah.
yeah.
Anything down on the what side is good?
Expenses.
And the liabilities. Yeah. So the up and down depends on what side of the equation you're on. Thank you very much. Okay? And that's all I want you to know. All right? For both horizontal and vertical analysis. All right? Same thing, income statement, same crap. This 100%, what does that represent?
Sorry?
This 100%, what does this represent? 100% of
Sales.
sales. So, if you take cost of goods sold and divide it into that, do you get 69? I know you won't believe that's the same arithmetic, it just looks funny there. 1043 divided by 14, whatever that is, do you get 69 point blah whatever? Yes, you do. Okay? So all we're doing is what? Looking to see what percentage of total sales is what? Cost of goods sold. What percentage of gross profit of total sales? That's all we're doing. So when we add this and this, we get to what? 100%. Same thing with expenses. 191 of total sales, 104 of, that's all that's doing for each year on the income statement in terms of the vertical analysis. Okay? Is more.
The vertical is more hard to interpret.
The vertical side? Yeah, what do you think the vertical is saying? If you look at it.
Right now it's
Because remember, all of these, from here all the way down, are a percentage of what? Total sales. Correct? For this year and this year. Because from cost of goods sold all the way down, we take the percentage of total sales. So all we're saying is, for example, net income in 2007 was higher or lower as a percentage of sales. Which one is it?
So,
It was 2007 was higher.
2007 was higher.
Right.
You follow? That's
All the percentages are based on total sales.
absolutely.
Okay, so the
Simple.
you divide them back into the total sales.
Absolutely.
Oh, okay.
Such that when you add all of these up, they must equal 100%. Because they all are part of the total sales. So everything is expressed as a percentage of total sales. for each one of the 2 years. Okay. So now your understanding of this is a little more sophisticated than your colleagues. Yeah, absolutely.
Creates a headache when you do
That's, well, nothing good comes easy. That's the crap. Now you have to go home and play with it again in a little while, get comfortable with it, and then you'll be a little more ahead in terms of your ability. So when you see a statement or situation, now you can say, where's my notes? Doggone it, let me see what the bank is doing. And then when you're in a staff meeting, you can say, excuse me, I noticed that the interest income as a went down last year. Could somebody explain why?
Blacklisted.
They say, see, that's the same thing. We send these people to do stuff, now they're questioning us. That was not the purpose. Get educated and shut up. Okay? All right. And then finally, ratios. Yeah, ratios show up all the time. Okay? Solvency versus liquidity ratios. There are 2 categories of ratios, and really all I need you to know for the purposes of this class is what they are by definition, and to be able to calculate simple ratios. That's it. All right? They're not difficult. You do have to spend a couple of minutes with each one, but once you get it, it's a piece of cake. What is liquidity, you think, by definition? Cash or cash equivalents. That's liquidity. Money that is available at a moment's notice. Solvency, on the other hand, has to do with whether you can handle your short-term and long-term debts when they come due. So you are solvent when you can pay your bills when they come due. You are insolvent when you cannot pay your bills when they come due. Okay? That's the point. Liquidity, on the other hand, has to do with having the available cash. Okay? A lot of people in the Bahamas and around the world, for example, have a lot of assets but no liquidity. You follow?
Rich and penny poor.
Yes, there you go. So can you say it again?
Land rich and penny poor.
Land rich. And if you really understand that, that's a serious thing. A lot of people are land rich and penny poor. They cannot find $3,500 if it kills them. But they have property over there, over there, over there, over there.
Senseless.
Absolutely. And that's okay to have the property. It's just that you have to recognize that you have to have some level of liquidity. You don't have to be filthy liquid, but you need to have what? Some level of liquidity. So if you get sick and the doctor say you need 500, you don't say, Jesus Christ, we need to have a cookout tonight. Yeah. You need to be able to find the 500. Now some people are in a little situation like, I guess like my son. He's a newlywed, just started working, whatever. You tell him to find 500, he'll probably lose his mind. Right? But not, other than that, hopefully in time, like in another year or two, like he'll be able to find 500 at a moment's notice. Okay? All right. So what's the formula for liquidity? What are the liquidity ratios? First of all, we have the what? Current ratio, which is what? Current assets divided by? Now, how will you know what they are? You'll be given them. You'll be given them, or they'll be on the balance sheet. All you need to do is take one divided by the other, and that's your answer. Don't lose any sleep. Quick ratio?
Current assets minus inventories divided by current liabilities.
Simple as that. Where's that information going to be? Given or on the balance sheet? Okay? What about DSO, Day Sale Outstanding? What's the formula? Divided by times, and you will be given that data. Okay? So don't lose any sleep. You know what total credit sales are by now, right? Are they payables or receivables?
What's that?
Total credit sales. Are they payables or receivables? Receivables. All right, way to go. Any more ratios? Solvency ratios, on the other hand. Debt to equity, what's the formula? That's it. The Bahamas needs to find out what our solvency ratio is in turn, particularly with debt to equity. Okay? That's because we need to know. Any other solvency ratios? Yeah, interest coverage ratio. What is the formula for that?
Operating income divided by interest expense.
Where do you think you get operating income from?
Income statement.
Income statement, remember? Total revenue minus total expenses equals operating income or operating loss. Absolutely. Any more ratios? All right. So we've seen the liquidities and we've seen the solvency. Let's see what they look like on paper. All right. Our balance sheet. We have Liquids Inc. and Solvents Inc. And we have all the information you need. That's how it'll look if you get a question on this. All your total assets, all your liabilities, all your longs, you'll have everything you need sitting right there. All you need to know is what? What to divide.
Yeah.
Now, if you mix up what to divide, dog eat your lunch. But once you know what to divide, all the numbers are going to be there for you. You will not have to calculate them. You will not have to figure them out. Just do the division and you have your ratio answer. See? This is what your answers will look like. If I say, what is the current ratio of Liquids Inc.? What's the formula again?
Current assets.
Divided by?
Current
Quick ratio is?
assets.
Minus?
Inventory.
Divided by? See? That's it. Debt to equity, which is?
Total debt
Divided by?
total equity.
Total equity. Is this a pretty picture just looking at this? Debt is 50, equity is 15. Is that it? 3.33, is that good or bad just looking at that? Bad, because debt is what? 3 times more than?
The equity.
So you owe 3 times more than you own. That's not good. Okay? Not at all. Okay. Formula for debt to assets? Total debts divided by? Simple as that. I mean, I know I say simple as that, but it's simple as that once you get it going. And the same thing on the solvency side. So some of the questions might be liquidity ratios and some might be the solvency ratios. Okay? Either way, they're not difficult. And you're going to have the information, the numbers that you need, right in front of you. Alright? And that's it, I think. Let's see. The rest is just for your reading pleasure. Alright? Variable costs and fixed costs, you will not be responsible for that area. I will not do that to you at this stage of the game. Alright? So in your review, please stop at liquidity and solvency ratios. You will not get any questions on variable and fixed costs. That's for another place and time because that involves a whole lot of stuff that's a little ultra virus beyond this particular session. All right, so that's it. Of course, we meet again next week, but we will not be talking about accounting. Do you know what we'll be talking about?
Finance and benefits.
Module 3.
Microfinance and benefits.
Yes, microfinancing and credit risk. All right, so that's what we'll pick up next week. But of course, next week I'll also bring your papers for the work that you did, and then we go from there. All right, again, if you have any questions, feel free to call me or send me an email. Doesn't matter, because we'll be doing this again for another 3 weeks. So feel free. If you get stuck on any accounting issues, even during the micro and the credit and all that crap, you can still ask me. Not a problem. Hi.
Are we still, next week is Thursday?
Yes. We continue with Thursdays.
When will you be assigning the personal assignment, part 1? Or who's assigning that?
Yeah, when Miguel gets back on Monday, I'll confirm that. When we come on Thursday, I'll let you know. Okay, yeah. All right, good luck with all the crazy stuff you guys are doing, plus work, plus this, plus that. And plus children, let's not forget that. And I'll see you next week. It's not easy, but thank God you're young.
If I'm not able to sit next week,
Don't go to Boston or New York.
I'm going to Boston on Saturday and then I go to.
Don't go to Boston or New York. I just came from New York a week and a half ago. It was a nightmare. Why are you going into a nightmare?
It wasn't supposed to be a nightmare. I thought
It's too late to cancel?
Too late to cancel. I thought March it was.
Well, I'll tell you like the kids on the block say, dog eat your lunch. But I wish you a safe passage and get the hell back quickly. It's a nightmare. Boston and New York.
When?
Saturday.
Kiss my foot.
I think the weather is supposed to be lasting until next week.
Yes.
The plane ran off the runway.
Yes, in New York, yeah, just after I came back, thank God.
It's Monday.
Today.
So it's too late to cancel?
Yeah.
Oh my God.
Wow. I'll pray for you.
It's
Keep you
March.
impressed.
We thought that
I know, but the weather is very unusual. Even the people in New York have said that this is the coldest weather that they have had in decades.
But even when I went that night,
Let's go to New Orleans.
Yeah, it's cold and I-
Yeah, no. Can you believe it? New Orleans is down south, isn't it?
Oh.
Yep.
I was supposed to go
I know.
middle of
My
the
brother
summer.
lives there.
You're not going anymore?
Atlanta's the same. Cold.
Yeah.
18,
All
20
even the
degrees.
southern states are very cold because the north is so cold.
Yeah.
2 weeks ago.
So I'm just like-
Yeah, I just came through Atlanta. It's a nightmare.
I can't really enjoy myself when it's too cold.
No man, you bundle up, you
Don't
get the
stay.
coat.
No,
I
I
don't
don't
stay
stay
in
in
my
my blanket.
Yeah, you have to stay locked up and wrapped
I
up.
wrap
Now,
up
if you're on a
all the
honeymoon or something,
That's the
or you with
difference.
somebody that you really like to be with, that's different. But if it's not that,
Rather cold or not?
Yeah, rather cold and hot.
hell no.
I could warm up.
I can warm up is correct.
I could warm up.
You can't warm up. You cannot warm up.
I could warm up. If
I
I
rather
hot,
cold
I
and
can't
heat.
cool
I
down.
can't dress
I'll go to New
where
York
you
if I
want
go
to
to
in the winter when it's too
Correct, you can't. You have to wear the same thing for the whole time.
I'm going to New York before I go Houston.
Exactly.
Yeah, one little, you can't look foxy and all that crap. I agree with you,
I
Latoya.
can warm up.
Absolutely.
I can cool off.
Good night.
Good night, see you next
Take
week.
care.
Take care, Damon. You can bring those ladies up to date.
Yeah.
Alright, good night.
Good night, good night. Oh my God, you're going to Boston?
It's gonna be,
My
I'm
dear.
not looking forward to it.
You have my
I was
condolences.
excited until,
Hopefully, maybe something might shift and change a little bit, hopefully, for you.
but they said the weather was supposed to warm up, but.
It might, and you have to hope that it does.
but
And if
how
it does,
much
then you would have
change-
gotten lucky.
But how much change will that be? Cause then it'll only warm up and then you have the black ice
Potentially,
and.
yeah. So you're gonna get some crap one way or the
Yeah.
other.
I don't-
So just, you have all the right clothing and blah, 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 your undergarments, your gloves, your hat, your
I don't
this, your
have a
that.
hat and all that, so as soon as I get there.
No, you need to get it before you get
We're
there.
in Nassau, Bahamas.
Order it online. Go online to Walmart. When are you going?
Saturday.
That's
It's
just
too late. The only
You
thing I
don't have
could
gloves?
do is in the connecting airport, I can purchase.
You can't find a pair of gloves.
I have gloves,
Good, you
it's
don't have a
hat I
hat.
don't have.
Go
Right.
somewhere, go to Lorene's or something, and if they don't have it, they'll be able to tell you who has it. You don't want to land in that place to find a hat.
Yeah.
Your head will be frozen
Yeah. I
before
know,
you get to the hat.
I know.
So go to Lorene's, if they don't have it, ask them, do you know who have it?
Yeah,
Until you find one.
okay.
Or if not, put an ad in the paper, I need a hat there,
Yeah.
bad, I'll pay extra.
My mom may have one, so.
There you go, but don't go without it.
No, I won't.
Okay.
Thank you.
Take care.